Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm here with Brian Gaynor from Milford Asset Management to talk about 2013 and the year ahead and what we expect to see in the world of investment. Brian, thanks for making some time for us. Now, you obviously you do your regular column in the New Zealand Herald and your first one of the year is quite upbeat. You're talking about 2013 perhaps being the year where we finally come out of the gloom and doom from the global financial crisis that's dragged on for the past 4 or 5 years. Why do you see this happening in 2013?
I see it. I actually am more optimistic about the world than most economists, because I see that the world was led down by the housing crisis in the United States, and residential property had a big impact upon the global financial crisis. And I see that residential property is improving right across the world, but particularly in the United States and in New Zealand, very clear signs of a pick-up in housing prices. And as prices pick up, you generally tend to get an increase in construction, and that's exactly what's happening. So the twofold impacts upon New Zealand are the Christchurch rebuild and an improvement in the housing market, particularly in Auckland.
Now, obviously, the housing market, especially Auckland, but also nationally, had a strong run, up about 10%, I think, the median price, according to the REINZ figures, yeah. Auckland a bit higher. Do you see this continuing? I mean, I guess the old theory is what goes up must come down at some point.
Yeah, it must, but probably not in the short term, because what we haven't had a lot of building of new houses in New Zealand. That's one of our biggest problems. Is elsewhere in the world during between say 2000 and 2008, there was a huge amount of houses built. We didn't build that many, so we do actually have a shortage. We do have a lot of problems getting planning permission, etc., in the big cities, particularly in Auckland. We may see a change, I think, to more medium density type housing, away from the kind of quarter acre. But I do see it, the way things are at the moment, I do see a lot of momentum in housing, particularly in Auckland, and the Christchurch rebuild should give a boost to the construction industry. And remember, housing has a big impact right across the board. It has on furniture, on carpets, on appliances. So it really is one of those things that leverages quite heavily into a lot of other areas besides the actual construction itself.
Now, obviously, as a fund manager, KiwiSaver manager, you mostly invest your clients' money in the share market. New Zealand share market had a great year last year, up 24%, one of the better performers around the world. Can that continue this year?
No, I don't think 24%. I would doubt that, but I still think you can get a better return from the share market than you can elsewhere. The kind of forecast we're looking at, and remember, these are only vague guidelines because you can never tell what a share market is, between 8 and 15%. I'd be very happy with anything around that margin. And of course, when you've got interest rates on term deposits at around 3.5% and 3.8%, no new bond issues, and even if there was new bond issues, I doubt if there'd be any more than 5.5%, 6%. A share market return of between 8 and 15% on average across the board is not a bad return. I mean, I wouldn't like to see the share market having another 25 to 30% year, because that would mean it would be getting overheated, and therefore the following year you might have some negative consequences of that.
Yeah, I mean, obviously you've been following the New Zealand share market for a long time, going back I think to the 70s. You've seen the 87 crash and all the other things that have happened since. When should we get concerned when the share market is running that hot? I mean, as you say, 8 to 15%, even that is a pretty good return on the back of a 24% one. At what point might we think, oh heck, this is getting a bit too good?
Well, we're a long way from that. For example, in the early 1980s, we had one year and 97% was up, and another year 110%. So we're nowhere near that. I think the biggest sign is IPOs, and I think they're going to be a big issue. In 1987, we had 65 IPOs. We had 2 last year. We've only had about 10 over the last 4 years in New Zealand. Now, when you get a lot of IPOs, and a lot of them are kind of very questionable, they're kind of, you might say, mutton dressed up as lamb, that's when we get to the danger points. We're a long way from that at the moment. I know people will say I'm a fund manager, I'd naturally be that way, but having been in the market for nearly 40 years in New Zealand and having watched it, we are absolutely nowhere near what we were in the 1980s. We could get there, however. The thing will be to watch. The IPO market tends to be a very good reflection on how overheated a market becomes. There's a lot of indications of, I would say we get between 10 and 15 IPOs this year. that's not enough to be overheated, but the quality is going to be quite important. If we start getting a lot of rubbish in there, that's a concern.
And now you did note in your column in the Herald that this is the particular area to watch, and especially, I guess, savvy promoters targeting naive investors who see these stories about the share market going up 24% in a year and get drawn back into it. So what are the signs with IPOs that people should watch for if this type of thing is going to happen?
Well, they've got to look and see if it's a substantial business, if it's a business that as actually they know about, because what happened in the 1980s, there was a huge amount of investment companies and property companies floated, but these companies had actually no assets. They were just raising cash, and once they got the cash, then they were going to buy businesses or buy properties. The big thing to look at is it a company that you know of, that's operating, that you have some awareness of, and is reasonably successful? So we want real businesses coming to the market, not cash boxes, and are companies that have no substance and have no operating records.
Obviously, Mighty River Power is the one that everyone's talking about. That's coming fairly soon. We've also got a sort of, a backdoor listing of the Mad Butcher coming. What do you make of those two?
It's hard to say because we haven't seen all the figures on the Mad Butcher, but it is a business that people probably will look at because it's got a good brand name in New Zealand. The one we do know about is Mighty River Power. And I can imagine that the demand, although there's a lot of political opposition to it, I would be very surprised if we didn't get in excess of the amount of investors that went to Contact Energy over 10 years ago. They got 226,000 investors. I'd be amazed if Mighty River Power didn't get over 200,000. Why? It's a company that people can understand. It's got a very good image and brand name. It's a very reliable industry, the electricity industry. And when you look at the Fonterra, for example, very huge demand for that. Shares issued at $5.50. They're nearly $2 higher at the moment. It just shows that there is really a strong interest in companies with good brand names that are well known. Genuine businesses that people know are genuine businesses. So Mighty River Power, I can imagine, will be very successful when it comes to the market.
Now, in your column, you also wrote about hedge fund guru Peter Lynch and his views on investment, and that when there are lots of sort of, problems and concerns around the world, such as global warming and ageing populations, and obviously high debt levels that both in terms of governments in some countries such as the US and Europe, and personal debt levels in somewhere like New Zealand, that these were good times to invest, and when everything looked rosy, it wasn't such a good time to invest in the share market. Just in terms of some of those points he raised, we still do have high debt levels, government debt levels, as I mentioned, in some countries, in New Zealand, household debt levels. Is that not still a concern?
The important thing that Peter Lynch was saying is you can have all these negative things out there, and unless they're going to get worse, it's probably a good time to buy. I see things improving over the next year or so. There is debt levels. There's high debt levels with individuals in New Zealand, and there's high debt levels in government, and certainly New Zealand government, although it's much less as a percentage GDP than other countries. The question is that situation going to get better or going to get worse? My own personal feeling is things are going to improve from here. I'm not saying dramatically, but as long as they start improving, you'll therefore see people responding positively and looking towards the share market. It's only if they get worse. The same thing too he talks about the worst time to buy is when everything is absolutely rosy. Yes, that is true if things are going to deteriorate from that point, although, if they continue to get better and better. But once things are so good, and that's what happened in 1986-87, everyone just thought that share markets can only keep on going off. We're in a new paradigm. We've solved all the problems, the economic problems that have befuddled the world for the last 50, 60 years. That's the time that you've got to be very careful about investing in shares. I think at the moment it's quite a good time because there is an awful lot of negative publicity out there, but I think we are beginning to deal with some of those issues, albeit we haven't completely resolved them, but the outlook in relation to most of them is probably slightly more positive than the opposite happening, which is them getting worse.
A lot of our regular readers have concerns about, the world's growing population and the finite resources we have, food and water and energy. What are your thoughts on those issues from an investor's perspective?
Well, they've always been. I mean, Thomas Malthus wrote about the world running out of food over 200 years ago. I mean, no matter what you look at it, there's always times in human history where people are concerned about all kinds of different issues. I guess I take the positive view, although because I always think that man's ingenuity and his ability to deal with problems has proven itself over the years. All I can see in my lifetime is a substantial improvement in the quality and quantity of life, and that's reflected in the fact that people are living longer, etc. So I guess I looked at things reasonably positively to say that we will deal with these issues. We won't completely resolve them, but we will get ourselves through. And what I see from the business point of view is a huge amount of enterprise and entrepreneurship. People looking to do things, wanting to find solutions to things, starting companies which they think will do quite well by delivering services to people that people will be prepared to pay. And that's our job, is to find those kind of companies. And no matter what situation the world is in, and despite the fears about global warming and aging of society, there will always be good companies out there to invest in that can give a return to investors that's higher than what they can get by putting their money in the bank. And that's really what fund management business is about.
Well, thanks for that, Brian. That's Brian Gaynor, Executive Director of Milford Asset Management, and I'm Gareth Vaughan at interest.co.nz.